So in this video, we're going to talk about the level of aggregation of insurance contracts. So in the original standard, this is paragraphs 14 to 24. So if we just read paragraph 14, it states that an entity shall identify portfolios of insurance contracts, and a portfolio comprises contracts subject to similar risks and managed together. Contracts within a product line would be expected to have similar risks and hence would be expected to be in the same portfolio if they are managed together. Contracts in different product lines, for example, single premium fixed annuities compared with regular term life assurance, would not be expected to have similar risks and hence would be expected to be in different portfolios. And then subsequently, it talks about in paragraph 16, the entity shall divide this portfolio of insurance contracts issued into a minimum of a group of contracts that are onerous at initial recognition. That's A. B says a group of insurance contracts at initial recognition that have no significant possibility of becoming onerous subsequently. And everything else, which is the remaining contracts in the portfolio. Now, on top of that, so those were two items. So the first thing is you need to separate in terms of the portfolios. Number two, you have to separate in these three buckets. Now, number three is that you shall not include contracts issued more than 1 year apart in the same group. So if we just take a step back and we think about what all of this is trying to achieve. Now, this all sounds a little bit complex, a little bit convoluted, and I haven't really explained what onerous means, and I haven't explained a lot of the other paragraphs, but I just want to set the scene for, at a high level, what this standard is trying to do with all of these paragraphs. So what I'm going to do is I'm going to draw a cube. Oops. Let me use the black color. I'm going to draw a cube. Okay, maybe it's not a cube. I'm going to draw a 3D figure. Okay, here we go. Imagine this 3D figure, looks similar to a cube, is our business. Okay, it's our book of business. Now there are 3 dimensions to this. Let's just say in the vertical dimension, this represents our underwriting year. Okay, in this direction, let's just say this represents our profitability buckets. And in this direction, this represents our portfolios. So what I'm going to do is I'm going to highlight this portfolios in yellow. I'm going to highlight the profitability buckets in blue. And then I'm going to highlight the underwriting year in green. Okay, so to match the highlighted segments in the standard. Now, I'm going to divide this cube up into little cubes. So, let me do this over here. Like so. Now I've got 3 profitability buckets, so I've got 1, 2, 3, right? Because it corresponds to A, B, C. Okay, so those are my 3 profitability buckets. Now this insurer or entity might have say 3, or so let's just call it 2 portfolios. So I'm going to have 2 portfolios. And let's just say this entity has 4 underwriting years. 1, 2, and 3 and 4. Okay, so as an example, this underwriting year would be, let's just say 2017, 2018, 2019, 2020. And the profitability buckets would represent onerous. Over this way, it's no significant possibility of being onerous on subsequent measurement, and this is other. And the portfolios, now this might represent, let's just say this one over here might represent lender's mortgage insurance, and then over here, this one, it might represent homeowners insurance. Okay, and when I say these profitability, these portfolios, it goes all the way up. Okay, so horizontally. So if we now look at our business, we've just divided these into lots and lots of little cubes. So what this standard is trying to do is really look at every single segment of these and to decide on which ones are actually onerous. So as an example, I could take the 2019 underwriting year for lender's mortgage insurance, and I could say that this one might be onerous. Okay, so in that regards, this one would be onerous, which is not good. Okay, and for this portfolio, it means the other two buckets. So the other two buckets for this no significant possibility and other, then those ones would not fit the 2019 lender's mortgage insurance group. Okay, so all of these little squares are, or little cubes, are groups. And then I might look at the 2018 lender's mortgage insurance, and then I might say, well, that one is actually profitable. Okay, so there's no significant possibility of being onerous. So then I would say, okay, this one is green because it's a good thing. So it doesn't fall into the onerous bucket. Actually, I've shaded the wrong area because I've shaded the onerous side. So let's just say, let's just call it 2018 homeowners instead of lender's mortgage insurance, because then you can see it, because I'm going to shade this area. Okay, so the 2018 homeowners, that's profitable. So I'm going to shade the middle cube because the onerous bucket doesn't apply to this one because we're saying it's profitable. So really what this is doing is IFRS 17 aims to shade or to compartmentalize all of the business segments into underwriting years. Okay, so the underwriting year could be a 1st of January to 31st of December underwriting year, or it could be a 1st of July to a 30th of June underwriting year, or it could be anything in between. But regardless of what's chosen, you cannot include contracts issued more than 1 year apart in that same group. And then after you form all of the groups, you try to fit it in the profitability buckets. So let me just go through another short example. So I have a blank canvas in front of me, and I'm going to draw a table. So let's just say this insurer is selling lender's mortgage insurance business. So this is a general insurance business. Lender's mortgage insurance, commonly referred to as LMI. So right now, before IFRS 17 comes to existence, this insurer is already selling lender's mortgage insurance. So they're already managing it. They might be selling it in a number of states. Let's just say they sell this in Queensland and they sell this in New South Wales and in no other states. Okay, and let's just say in Queensland, they sell it in two suburbs. So suburb 1, suburb 2, and in New South Wales, they sell it in two suburbs, suburb 1 and suburb 2. And let's just say they've been writing this business for 2 years. Okay, so let's just say they've been writing it for 2019 and 2020. So just these 2 years that they've been writing lenders mortgage insurance. So first of all, if this company has other portfolio or other lines of business, as an example, if this company has homeowners, or if this company also writes consumer credit insurance, then by the very nature, right now, we are considering these as separate lines of business. You have separate teams managing the business. So that's usually enough for this to be regarded as not being similar risks and not being managed together, but being managed separately. Okay. What is less clear is whether this similar risks are managed together. Is that can we consider lender's mortgage as the entire book as being one portfolio? Or do we have to consider Queensland as one portfolio and New South Wales as one portfolio? Okay, so there isn't a real consensus on this. Some companies are going the more granular approach, and some companies are going the more high level approach. I guess the biggest thing with having I guess the biggest benefit with having a high level approach, for example, having lenders mortgage insurance as the entire portfolio, is that you have more room to offset some of the calculations and to allocate some of the calculations when you calculate the insurance liability versus insurance assets. Because you can, in one of the amendments recently, you can offset some of the liabilities and assets if these, if these groups fall under the same portfolio. So if your portfolios are more granular, then there's obviously less of a chance you can offset things. If your portfolio is at a high level, then you can offset things more frequently, or there's a high chance to offset things. Okay, so that's the portfolio element. Now let's go back to the cube example and let's apply it to this particular scenario. So if I were to draw a table summarizing these states, what I can do is I can say, okay, well, state over here and suburb over here, underwriting year over here, and profit bucket. Okay, so Queensland, let's put that down. So I'm going to have a few lines for Queensland and you'll see why. So there are two suburbs in Queensland, and we're saying that there are two underwriting years. And 2020. And for New South Wales, we also have the same. New South Wales, 1122. And I'm just going to add the underwriting years here. Now, what we can say is for the profitability bucket, maybe the 2019, or maybe Queensland is just a bad book of business. Maybe we've been writing in Far North Queensland and we've been writing more of that in the 2019 underwriting year. So let's just say this is onerous. And doesn't matter the suburb, let's just say suburb 2 is also onerous. And in 2020, we couldn't change our underwriting strategy for suburb 1, but we did change it for suburb 2. So suburb 2 now suddenly becomes no significant possibility. And let's just say in New South Wales, 2019 was also a difficult underwriting year. So let's just say this was onerous, but let's just say all the other ones were no significant possibility. Okay, so no significant possibility and no significant possibility. So what that's really done is it means that now we have one, oops, let me use a different color pen. It means that we have 1, 2, 3, 4 onerous groups. Okay, so and these are all measured at initial recognition. So really at the inception of the contract. Now, these groups where we're saying there's no significant possibility, they could fall onerous in the future. Okay, so right now at initial recognition, they're not regarded as onerous, and we don't think that there's a big chance that they're going to fall onerous, but they could fall onerous in the future. And if they do, this actually does not change the groups that they're in. Okay, so these groups over here, so let me highlight these groups over here, these groups are assigned at initial recognition. And once we assign these groups, they don't change. So if an onerous group does not end up being onerous later on, that still falls in the onerous group. It's just we don't recognize it as onerous when we recognize the profitability trends over time. But, and also if you have a group that has no significant possibility of being onerous at initial recognition, but then subsequently it does become onerous, then it doesn't move between groups. It just becomes recognized in the profits as being onerous. And recognition of onerous means that you actually bring forward all of the future losses. All right, so it's very similar to in the current accounting for general insurance and life insurance under AASB 1023 and AASB 1038 as the LAT, the liability adequacy test. Okay, so that's a similar test, but now IFRS 17 wants us to do it at a much more granular level. So I hope this video helped give some, I guess, illustrations and give some light into understanding what these paragraphs means in terms of a portfolio versus a group versus the profitability buckets. And sometimes people use these words, the word cohort. You might hear them, people use the word cohort, and they generally mean the underwriting year of a group. Okay, so in other words, Queensland is an umbrella under the portfolio, and these are the suburbs, another sub umbrella, and some people regard these as cohorts. Okay, so you might hear that used, and that's not a cohort. It is not used as widely as a group. The standard likes to refer to things as groups, but just bear in mind that some people might use the word cohort. So I hope this helped explain and clarify some things, and I'll see you in the next video.